Amen. Okay. Senator Hagerty.
Thank you, Chairman Scott and Ranking Member Warren, for holding this meeting. And Chairman Powell, it's good to see you here again. Chairman Powell, I want to talk with you about inflationary and deflationary trends in our economy and how they impact your thinking. I understand, based on your testimony and recent statements, that you're acutely sensitive to the inflationary risks of our administration's trade policy. And though I note that it's not the Fed's responsibility to attempt to steer or to directly offset that policy in any way, I look at that. I look at your perspective, but I also look at many of the other developments in our country that I think present the opposite risk, which is a disinflation risk. And let me dig into this a bit. We're witnessing artificial intelligence adoption at breakneck speed. That's going to bring about productivity gains in nearly every aspect of our economy. We're about to pass a tax bill. That tax bill is going to encourage capital expenditures and long overdue upgrades to our manufacturing capacity, again, increasing productivity. And if you think about the concerted effort that's being undertaken by our federal government right now to reduce waste and bloated, unproductive government payrolls, all of these point to disinflationary productivity gains. So given the competing sources of uncertainty that we're talking about, it feels to me like the Fed's far more focused on tariffs and the inflationary impact of tariffs than on the deflationary impact of the points I just mentioned. So if uncertainty around tariffs is the primary reason that impacts your thoughts, I mean, how do you counter, how do you bring into account these disinflationary trends that I've just mentioned?
So we do look at the overall picture, and that's actually what's been happening is services inflation's been coming down, and that's been covering what we see so far, small increases in goods inflation. I would also mention a factor that you didn't mention on your list, which is regulation, which is an area which could also be over time disinflationary. Yeah. So we get that. I mean, I try to say that it's the broad sweep of policies and the broader economy that matters for inflation. I get asked about tariffs a lot, and that's the one where all forecasters are expecting, a significant increase between now and the end of this year. We don't know how big it's going to be. We don't know when it's going to come, but it's just something that we're waiting to see more information on so we can make a better decision on interest rates. That's all it is.
Well, I hear the discussion about not knowing the magnitude and the timing of the trade talks and the resulting tariffs that will ensue. It does seem to me that there's a bias toward viewing this as more inflationary than deflationary. And I'd like to ask you this. If Ambassador Greer is successful at bringing the trade deals together soon and alleviating that uncertainty, what would that do to your perspective on rates? Would that put you in a position to think more aggressively about lowering rates?
Yes, potentially it would. I mean, really, it's reducing uncertainty would help, and also just what's going to be the final tariff rate and getting that settled. And I think that's the path we're on.
I think that's welcome news. I think the markets will welcome that as well, because I do believe that we're on the path, as you're about to say, of having some significant resolution in trade uncertainty. We've lived in an unbalanced world for years, where the United States has had the lowest tariff barriers in the world, and other nations have taken advantage of that. Jameson Greer and this team, Scott Bessent and his team, the president, everyone is making a concerted effort to fix this. So I'm looking forward to that. One other area I wanted to touch on, because it's touching close to home, and that is legislation that this committee has just passed out and that we've just passed in the Senate. That's to do with the Genius Act. We just passed it last week, and it provides an urgently needed regulatory framework for payment stablecoins, and it requires that they're backed one-to-one by cash or short-dated U.S. Treasuries. Over the last 5 years, the total value of outstanding stablecoins has increased from approximately $4 billion to over $2 billion today. One market participant has predicted that if a framework like the Genius Act is adopted, total issuance of dollar-pegged stablecoins could reach nearly $4 trillion by the end of the decade. So I wanted to get your perspective again, Mr. Chairman, of what impact would this new source of demand for bills have on the yield curve, and in particular, what impact would it have on short-term rates?
So more demand is going to have a tendency to drive down rates. I don't really have a sense of how big that effect would be, of course. And let me just say that it's a great thing that we're making progress toward a stablecoin framework.
Thank you, Mr. Chairman. I couldn't agree with you more. The direction clearly is that it's going to drive rates down. I think it's very positive for the economy, positive for our cost of borrowing as a nation. And I appreciate your response there, Mr. Chairman. Thank you very much for the
Yes,
time.
sir. Senator Cortez Masto.